Welcome to today's lesson on initial public offerings, or IPOs. Understanding how companies go public is fundamental to grasping how stock markets work. An IPO is a major milestone in a company's journey, transforming it from a privately held entity into a publicly traded corporation. Throughout this video, you'll learn what an IPO is, why companies choose to go public, and how the entire process works from start to finish. An IPO, which stands for Initial Public Offering, is the process where a private company offers its shares to the general public for the very first time. Before an IPO, a company is owned by a small group of people, typically the founders, early employees, and private investors like venture capitalists. After an IPO, anyone can buy shares of the company on a stock exchange. This marks the transition from private ownership to public ownership, allowing everyday investors to become part-owners of the company. There's a fundamental difference between private and public companies. A private company is owned by a limited group, such as founders, employees, and private investors. These shares are not available to the general public and cannot be traded on stock exchanges. In contrast, a public company has shares that are listed and traded on stock exchanges like the New York Stock Exchange or NASDAQ. This means anyone with a brokerage account can buy and sell these shares. Public companies also face more regulatory requirements and must disclose financial information regularly to shareholders and the public. Companies decide to go public for several strategic reasons. First, raising capital for expansion is a primary motivator. An IPO allows companies to raise substantial funds that can be used for research, development, acquiring other businesses, or expanding operations. Second, it provides liquidity to early investors and employees who hold stock options, allowing them to sell their shares and realize gains. Third, going public increases brand visibility and credibility, making the company more recognizable to customers and partners. Finally, being publicly traded enables companies to offer stock-based compensation to attract and retain top talent. The IPO process involves several critical steps. First, the company hires investment banks to act as underwriters. These banks guide the company through the entire process and help sell the shares to investors. Second, the company must file a registration statement with regulatory authorities like the Securities and Exchange Commission, which includes detailed financial information and business plans. Third, the company conducts roadshows where executives present to potential investors to generate interest and help set the IPO price. Finally, once approved, the shares are officially listed on a stock exchange and trading begins. The entire process typically takes several months to complete. Three main groups play crucial roles in an IPO. The company itself is at the center, deciding to issue shares and determining how many to offer. Investment banks, known as underwriters, manage the entire process. They help determine the offering price, market the IPO to potential buyers, and often guarantee the sale of shares. Major investment banks like Goldman Sachs or Morgan Stanley typically serve in this role. Finally, there are the investors, both institutional investors like mutual funds and pension funds, as well as retail investors, individual people like you and me, who purchase the newly issued shares. Each player has distinct motivations and responsibilities throughout the IPO journey. Investing in IPOs presents both opportunities and challenges. On the benefit side, IPOs offer early investment opportunities in companies that may experience significant growth. If the company performs well, early investors can see substantial returns on their investment. IPOs also provide portfolio diversification by adding new, potentially high-growth companies to an investor's holdings. However, there are notable risks. IPO stocks often experience high price volatility, especially in the first few days and months of trading. Additionally, since the company is newly public, there's limited historical trading data to analyze. Some IPOs also have lockup periods, which restrict when early investors and insiders can sell their shares, potentially affecting stock price once these periods expire. Let's recap the essential points about IPOs. An IPO is the process that transforms private companies into publicly traded ones, allowing anyone to invest in them. Going public provides companies with access to capital and gives early investors liquidity, but it also brings increased regulatory obligations and public scrutiny. For investors, IPOs present exciting opportunities to invest in growing companies, but it's crucial to assess the risks carefully. Not every IPO succeeds, and prices can be volatile. Always conduct thorough research, understand the company's business model, and consider your investment goals before participating in an IPO. Thank you for watching, and happy investing.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.